The collapse of Silicon Valley Bank in 2023 was not just a glitch in the system. It was a preview, a controlled burn to test how the financial world would react when trust in banking began to crack. But what if I told you that wasn't the end? What if that was only the beginning of something much larger, something designed to fail? Bank runs have always haunted modern economies. They begin quietly like a whisper. One customer pulls out their funds, then another, then 100. Before you know it, the entire system spirals, not because it's insolvent, but because people believe it is. And that belief is deadly. Silicon Valley Bank's failure was triggered by a combination of rate hikes, unrealized losses, and poor liquidity management. But let's be honest, that's just the surface story. Beneath that, something else was happening. Something strategic. Because when banks go down, power consolidates. In 2023, we were told it was a one-off, that the Federal Reserve stepped in to prevent contagion, that the system was sound. But here's what they didn't say. More than 190 banks were sitting on similar unrealized losses, and that was back when rates were lower than they are now. Fast forward to today, rates are still elevated. Commercial real estate is cracking, and depositors are quietly moving their funds into higher yield assets like money market funds and treasuries. That's not just reallocation. That's the early signal of capital flight. If another regional bank were to fall today, the public wouldn't be shocked. They'd be ready. They'd be faster. The withdrawal lines wouldn't form at the branch. They'd happen instantly, online, mobile, automated. This is what makes the next bank run different. It won't be visible until it's too late. In the age of digital banking, a silent panic can evaporate billions in deposits overnight. No headlines, no warning, just zeros disappearing from one institution and reappearing somewhere safer. It's not paranoia, it's logic. So the real question is, who's vulnerable? Start with regional banks. Many of them still hold long-duration bonds and mortgages on their books. As interest rates rose, those assets lost value. If they were forced to sell today, they'd realize losses that could wipe out their capital buffers. Add to that declining commercial real estate valuations. Office buildings in major cities like San Francisco, New York, and Chicago have seen drops in occupancy, rent, and resale value. Banks exposed to these properties are carrying ticking time bombs on their balance sheets. And here's where it gets more dangerous. Large institutional clients, the ones with millions or even billions in deposits, are already moving their money preemptively. They don't wait for FDIC assurances. They move based on risk models, not press releases. You might be thinking, well, the government will just bail them out again. But that assumption could be the trap. The political will for another large-scale bailout is eroding fast. The public is angry, fractured, and watching every dollar. And this time the narrative has shifted. In the SVB collapse, the government had to walk a tightrope. Bail out depositors, not investors. Claim no taxpayer money was used. Frame it as system protection. But if 2, 3, or 5 banks fall in rapid succession, can that narrative hold? There's a reason the FDIC quietly updated its resolution protocols last year. There's a reason the Federal Reserve launched emergency lending windows that few people understood. And there's a reason why central banks around the world are accelerating development of digital currencies. They're preparing for systemic stress, but not in a way that prevents it, in a way that redirects it. And this brings us to a much bigger point. Silicon Valley Bank, the 2.0, isn't just about one bank. It's about how the system resets, how failure becomes an excuse for consolidation, for control, for ushering in central bank digital currencies, tighter capital controls, and potentially programmable money. The illusion of safety will be offered in exchange for total visibility. Let that sink in. Because if the public is spooked by the volatility of private banks, the solution becomes obvious. Move into a new safe system, a government-backed digital ledger, one where you don't just deposit your paycheck, you plug into a monitored financial grid. You won't be told that directly. It'll be offered as convenience, as safety, as resilience. But make no mistake, every bank failure paves the road closer to that system. Governments are partnering with fintech firms, and the IMF, World Bank, and BIS are all coordinating on frameworks for digital currency interoperability. This isn't speculation. It's strategic design. Now consider this, if a new round of bank runs began next quarter, who benefits? Is it the regional bank holding legacy mortgage assets? Is it the depositor losing sleep over FDIC limits? Or is it the centralized entities who step in to offer a better system? And more importantly, who gets left out? Low-income account holders, small business owners, retirees who can't move their funds in real time. These are the people most impacted by liquidity shocks. These are the ones whose accounts get frozen, delayed, or wiped out by cascading institutional withdrawals. Now we need to look at what's happening under the radar. As of this week, U.S. commercial bank deposits are still over $17 trillion, but they've declined steadily since 2022. Meanwhile, money market funds have hit record highs, over $6 trillion and climbing. That's not a coincidence. That's capital in motion. Institutions are choosing yield and safety over loyalty, and that's the canary in the coal mine. Let's be brutally honest here. You don't need a conspiracy theory when the data is this clear. The financial system is a confidence game, and once that confidence breaks, even slightly, the machinery stops. Liquidity freezes. Panic spreads. And the people left holding the bag aren't the ones who caused the collapse. They're the ones who believe the story the longest. You have to ask yourself, if another bank failure happened tomorrow, what would you do? Would you move your money? Would you wait for a government statement? Would you trust that your deposits were safe? Because the next time it happens, there won't be much time to decide. And that's the part no one talks about. The new age of banking is fast, digital, and fragile. It doesn't break with noise. It breaks in silence. And when it does, the system that replaces it will already be waiting. If this opened your eyes even a little, do one thing before you go: subscribe. Because what's coming next won't be explained after it happens. It'll only be clear to those who saw it before it hit. And right now, the clues are everywhere, hidden in plain sight. Look at the patterns. Major banks are offloading commercial real estate exposure at steep discounts. Regional lenders are merging not for profit, but for survival. And behind the scenes, central banks are coordinating policy moves with a speed and precision we've never seen before. Ask yourself why. Why would the Federal Reserve, the European Central Bank, and the Bank of Japan all simultaneously test cross-border settlement layers for digital assets? Why would the IMF publish a blueprint for global digital infrastructure, timed with rising distrust in traditional banks? And why would major financial institutions start investing in blockchain-based settlement networks while publicly claiming that crypto is dead? It's not contradiction. It's choreography. They're building the next system while the current one quietly erodes. And that system is not designed for freedom. It's designed for compliance. This is foresight, not fear. The next phase of the financial system won't wait for permission. It will arrive quietly, reshape everything, and reward only those who are ready before the shift. If you're not watching the patterns, you'll be trapped in them. If you want to stay ahead, understand the deeper moves and protect your position while there's still time. Subscribe now. Because the world you're waking up in is not the one you remember.